Options are a powerful way to generate income on stocks that you own or want to own, but they can also be confusing and very risky if you don't know what you're doing. That's why I stayed away from options for the first 12 years or so of my investing career. But I recently tried the wheel strategy for the first time ever on the stock Lululemon. And in this video, I'm going to go over exactly what happened, what I earned, and some mistakes I made along the way. We're going to cover those two option types that make up the wheel, the cash secured put and the covered call, and a few big takeaways for beginners so you can decide whether this strategy might be right for you. So the wheel strategy has two option types. It starts with a cash secured put and then it goes into a covered call. The cash secured put is basically an obligation to buy a stock that you don't own. And then a covered call, once you own the stock, is a way to make premium on a stock that you do own for an obligation to sell it. So let's start off with cash secured put. It's otherwise known as a CSP. Selling a CSP gives you a premium, and in exchange, you are obligated to purchase 100 shares of the stock at the agreed price, also known as the strike price, on an expiration date. So let's make that concrete with an actual example. In my case, I sold one put, and I received about $290 for the obligation to buy Lululemon stock at about 11% below the price that it was trading at in 39 days. So you can think of it like a limit order. I'm agreeing to buy the stock if it drops below a certain price. And there are two possible outcomes for this scenario. The first is the stock is trading above the strike price, and in my case, my strike price was $185 at expiration. And that means that it's going to expire worthless. The option expires worthless, and I just keep the premium. And that's kind of the most likely scenario that a lot of option traders aim for. You just collect that premium, and then you rinse and repeat and do that many months in a row. The other scenario is that the stock is trading below the strike price at the time of expiration, and then I get assigned the stock in that case. I then have to buy the stock at the strike price of 100 shares at that price. So it's important to note that this is a cash secured put. And what does that mean? It means that I have to have the cash in my account to execute that trade for the entire time that I own the option. So in my case, one put is 100 shares at $185 a share. And so I needed to have $18,500 in my account the entire time. So the important thing, though, also is to note that that cash is still just cash in your account. You can't use it for anything else, but it does collect a yield. And so you can collect something like 3% on that cash while it's sitting there, in addition to the premium that you're gaining from the option. So the big takeaway there is that it's unlimited downside, just like owning the stock. So the stock price could go to zero and I could get $0. I could lose $18,500 in that case. And there's limited upside, meaning the most that I could potentially make is the premium if the stock soars. So the stock strike price was 185. If it goes to 190, 200, 220, I don't gain any of that extra benefit, but I do just gain the $290 in the premium that I did collect. So unlimited downside, limited upside. However, I do get that cash flow. Now the second option strategy is called the covered call. I receive a premium in this case for the obligation to sell 100 shares of a stock at a strike price at an expiration date. So a concrete example here is I did enter into a contract to sell Lululemon at $180 when the stock was trading at about 10% below that price. And again, we have two possible outcomes here. The first is that the stock is trading below the strike price of $180 at expiration. And that means that the option expires worthless and I just get to keep the premium. Again, that's the most likely scenario. The stock price is just going to wobble, for example, most of the time, or go up slightly or go down slightly, and then I would just collect the premium. The second scenario is the stock is trading above the strike price at expiration, and then I get my shares called away. And then I'm basically forced to sell the stock at the strike price, foregoing anything above the strike price. And again, we have a similar situation to the cash secured put where we have unlimited downside. I own the stock in this case so that it could go down to zero and I could lose $18,500. Or the stock could go up, it could double, and I would only get limited upside. I would get the gap between the current price and the strike price. So I would get the benefit of that, and I'd also get the premium. And the premium I get no matter what. So again, similar to the cash secured put, I've got an unlimited downside and limited upside. So let's move to the Excel spreadsheet and walk through my actual purchases. As you can see here, I started the strategy on January 12th of this year, 2026, by selling a cash secured put that expired 39 days in the future on February 20th. and I collected $290 premium. The stock was trading at $207 at that time, and the strike price was $185. So I was agreeing to buy the stock at 11% below its current trading price, and it already dropped about 40% in the past year. So I thought I would have a really reasonable chance that the stock would not continue declining, but as you'll see, it did. 39 days later, it was right about to expire in late February. So on February 18th, 2 days before it expired, I decided to roll the cash secured put, meaning I closed the first put and then I created another one, and I was able to collect cash of $314. So I extended out my obligation for another 30 days, and in exchange, I also dropped the strike price down by $5 per share. So now I'm obligated to buy the stock at 180 instead of 185, and I collected $314 of premium in that case. The stock did continue to decline. Unfortunately, it fell even harder, and it at the time of expiration, so March 20th, actually a day before expiration, I was assigned the shares. So this was something I didn't know that could happen, but it did happen because I was so far in the money. The other side of the trade was executed on my end before the actual final day. It was a day before, and I was executed that stock. So I had to pay $180 a share for Lululemon stock, even though it was trading at $168 a share at the time. So that kind of hurt a bit. Then just a few days later, though, I decided to sell a call. So the second part of the strategy after the cash secured put and you get assigned the shares is you sell a covered call. So I did sell a covered call just 2 or 3 days later, and I collected a premium of $220 for that. Agreed to sell the stock at $180 a share. So that would have basically given me a break-even situation, not including all the premium income. The stock kind of crashed over the next week or so, and so the call that I had was basically worthless. So it was okay for me to roll it in that case, and so I did. I rolled it another month. So now I rolled it from March 30th into the May 15th option time frame. And for that, I collected $188 a share, but I also had to lower the strike price to $175. So now that's where I'm currently sitting. I'm currently obligated to sell Lululemon stock if and when it trades above $175 a share in late March. So altogether, I collected $1,000 in income in those 4 trades and over less than 3 months. And that works out to a return of 5.6%. If you annualize that, if I'm able to do that every 3 months, that would be 24% return, which I think is pretty amazing. My effective price on the stock is $170 a share after reducing the $180 a share by roughly $10 a share in premium income. And today the stock is trading at 160, so I'm looking at paper loss of about 5.5%. So the main takeaways, the big one is this strategy does deliver some pretty significant cash flow that does feel like free money in some cases, even though it isn't. I was able to keep in mind Lululemon does not deliver any kind of dividend, and it was dropping for this entire time. So I was able to get cash flow of 5.6% return in just 3 months in cash from a stock that doesn't pay a dividend, and I was able to generate positive cash flow on a stock that was also declining for this entire time. The other big takeaway is that I wouldn't recommend this for any stock that you wouldn't be happy to own over the long term. Lululemon is a stock that I've been watching for many years. I've been very impressed with their margins and cash flow and the brand, and I just think that the business is going to recover from this current slump that it's in. And I am prepared to own the stock for several years if I need to, but I would not do this strategy on a stock that you don't feel that way about. So let me know in the comment section below if you think you might do an option trade like this, or if you have any questions about the trades that I did. I just wanted to give you my experience as someone who's tried this for the first time to help beginners decide whether they want to do this option strategy themselves.